and welcome to the Morningstar series Why Should I Invest With You? I'm Emma Wall and I'm joined today by Mark Warrior, manager of the BlackRock UK Income Fund. Hello, Mark.
Morning.
So you've run this fund for 2 years, a turnaround story in your own words, and you took it over at a time when yields were already looking difficult to find. You know, we've been 5-6 years of low interest rates now in the UK, which has put pressure on UK equity income to provide that income that people were previously getting from cash. It's created this phenomenon called bond proxies. Perhaps you could start by explaining what they are.
Yeah, well, I think it was very timely when we took over the fund, because I think in the preceding decade, income fund managers have performed very well versus the index. And I think you've almost had the perfect environment for income managers, this drumbeat of falling interest rates, falling bond yields. And we felt that 2 years ago, we're going to move into a different environment. Yields aren't going to take off, but they're going to gently rise. There's going to be more volatility. So rather than focusing on traditional bond proxy type companies, so those companies where the bond yield is a driver of the rating of the companies, such as utilities and real estate companies, we decided on having a much more flexible approach. So yes, we invest in companies that generate dividend yields from free cash flow, but we also invest in growth companies and turnaround situations. Because I think just using one golf club out of the bag is not going to be enough going forward. So you need to use all of the golf clubs and invest in different types of companies that can generate the yield. So
would that lead to you, for example, buying a company that perhaps is not yielding yet?
Yes, we tend not to invest in companies that aren't capable of generating a yield. So biotech, oil exploration, mining exploration, you usually need a pair of binoculars to see the yields on those companies, so they're off bounds. But companies that perhaps have gone through a restructuring, Lloyds Bank is a good example, that is now going into a period of paying a dividend, yes, those are candidates for the fund.
And if you just take a high yield approach, picking out those companies that are yielding above a certain threshold that you set yourself, you find a portfolio is very concentrated in particular sectors. Are you finding your approach leads to a more diversified portfolio?
Yeah, we do run a relatively concentrated fund, so 35 to 45 stocks. I think even the best fund manager doesn't come up with more than half a dozen really good ideas during a year, so why dilute that in a big portfolio? We like to keep it focused. But what we found is that we can generate yield from lots of different types of companies. So yes, we do have some larger companies, which in many cases look very cheap at the moment. But the UK market is great in that we've got lots of different sectors, lots of different themes, companies that distribute capital through share buybacks or who periodically pay special dividends. So lots of levers to play in terms of generating that yield.
And although you have, as you say, restructured the portfolio so you are less sensitive to interest rate rises, it is, of course, something that's not unavoidable. How do you feel about the threat of interest rate rising?
Yeah, I think we're at the stage in the UK where rates do need to rise. It's interesting just looking at some of the wage settlements that are going through at the moment. Sainsbury's a couple of weeks ago put through a 4% wage increase on 137,000 people. And actually this living wage is starting to trigger some more of those types of settlements. So that is pretty inconsistent with a 0% interest rate environment. So I think rates will have to go up over time. But this is a global issue, and really what the US does, they are the economy that sets interest rates, and we'll have to follow in that shadow.
Mark, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.